Nathan with CrossCountry Mortgage. Nathan, can you tell us a little bit about yourself?
Yeah, hey guys. Yep, Nathan Mazalewski. I'm a mortgage loan originator with CrossCountry Mortgage, and I'm here to answer any questions you guys may have regarding the pre-approval process for any potential clients and why it's best to move forward and get approved for a loan before they go shopping for a home.
Okay. Yeah, that's actually our first question. So why would somebody want to talk to you first before we go out and start looking at some new homes?
In general, as you guys know, you want to make sure you have a qualified buyer before you go out, take them into the field looking at houses. The listing agent, whoever's selling the home, isn't going to take an offer, isn't going to take a buyer seriously unless they know they've spoken, they're qualified, been pre-approved for a mortgage loan. They have the financing, they have the ability to buy that house. That's the main reason that you're going to want to get pre-approved for a mortgage.
Gotcha. I know I've had, a lot of times because of course I'll show somebody a home without a pre-approval necessarily, but it's always kind of a hard conversation when they do get that pre-approval if they're not qualified in the price range that we've been looking at. So I know that it helps a lot to kind of narrow down the properties a potential buyer may look at, once they have the loan type and kind of the pre-approval and the amount that they qualify for.
It does. We've had, and you and I, Dante and David, you and I as well, have had issues or buyers that they want to go out and they want to get this $300,000, $400,000, $500,000 house, but then they want a payment that is really going to be closer to a $200,000 or $300,000 home.
Mm-hmm.
So it's good to get that covered up front. There's no sense in showing somebody a type of a home that they simply can't afford. They may have in their head, oh, I want to live in this neighborhood. I want to have this type of property. But the reality is they can't afford it. The payment has to be structured, set at a lower price point. It's just going to save you and them a lot of time and aggravation.
I think we get some fight back from buyers as well. Typically the first-time home buyers, at least in my case, and I'm sure David's been through this as well. But people that bought homes in the past, they already know the process. Like, hey, I've been in touch with the lender. I'm going to need to be in touch with the lender. Whereas first-time home buyers, they don't know that step. And they kind of give you some fight back as agents, right? Oh, you don't want to show me the house because I don't have a pre-approval letter. Well, it's not that case. We don't want to waste your time or our time, right? Showing your houses that you might not qualify for. So why don't we skip wasting all that time? Let's talk to a lender, see the number you can qualify for, then just look in that range of homes that you can afford.
They need to have a conversation with someone like myself to find out, one, what it's going to take to get qualified, how they get qualified, and what that payment's going to look like. They may have in their head they want to spend X amount of dollars, and the reality is the houses that they're looking at is that dollar amount plus another 1,000 or two that they simply don't qualify for, or don't have the ability, or don't want to pay. And we can just avoid that whole situation up front if they get pre-approved, if I have that conversation with them to let them know what their payment's going to look like.
Yeah, and on the seller side as well, like sometimes you have to tell them, hey, put your shoes in the seller side. They don't want random people looking at their house, scheduling showings, having to leave the house for showings, not knowing that you guys aren't even qualified.
Right.
So I think it does both justice for the buyers and for the sellers. It's a thing that kind of helps both out.
And I see it sometimes too, where and it makes sense. Somebody sees a home online that they really like and they want to go see it. And, maybe that's a $400,000 or $500,000 house. And then we go see it, they get excited. That's the type of property they're looking for. And then they get their pre-approval and maybe they're only qualified for $350,000, $375,000. And now they're kind of disappointed. And so that's kind of rough. And it also answers, for me, my opinion, it answers a lot of questions too. Because once they speak with you, then they start asking, well, how much is this going to cost and that going to cost? So it helps to kind of prepare them for what's coming down the road.
Yeah, I agree. Now, speaking of different loans, obviously we just spoke about first-time home buyers. You have your, investors, but there's so many different types of loans, Nathan, which I don't think a lot of buyers are educated on. I'm just sharing this a little bit about what type of loans there are, and even just the basic ones. I know there's more complex ones, but the most basic, what are those loans?
Yeah, there's three traditional categories that it's going to fall into. The conventional loan, and that's, I don't want to call it the A paper, but that's where kind of the top place that I don't want to categorize, because there's plenty of strong borrowers that go into government loans. There's advantages and disadvantages of all the loans. With a conventional loan, it's probably the least expensive loan that you have. You can get away with you can put 20% down, have no private mortgage insurance. For those that don't have the full 20% down payment, you can get away with 3%, even 5% in some cases. The conventional loan is going to require a higher credit score. It's a little bit more difficult to qualify for than some of the others, such as the government loans and the non-conforming or non-QM loans. Government loans typically are going to be your VA, FHA loans. VA is it's an excellent loan for any veterans. 0 down payment, you can get in with no money down. They do have additional costs. Any of the government loans, the FHA, the VA, they're going to have additional costs to it that the conventional loans will not have. One of the advantages, again, of the government loans is you're going to have with the VA, you can have a 0 down payment. With FHA, you can get away with 3.5% down, but they do have, like I said, additional costs. In addition to that, one of the other advantages of going with the government is the credit score bar is set lower. With a conventional, you're probably going to need to be in the high 600s, low 700s to qualify. With government loans, you can dip down into the 500s, high 5s, and still qualify. And then when you talk about getting into the third category for someone that doesn't maybe show income on paper, a non-QM or non-conforming loan, you're going to pay a much higher interest rate for those, but it still gives you the ability to get into a home.
And for those who don't recognize those type of loans, they also call them no-doc loans, right? It's the same.
Yes, or stated. Maybe you can use a bank statement loans. That's a little bit more complex, but it is a different category.
And those are those for individuals that don't necessarily have a W-2? Maybe they are self-employed.
Self-employed. Correct. Investors will often go with the non-QM or the investor type loans.
Right. So for like hospitality, like restaurant industry, servers, waitresses, anybody that kind of like makes, I don't know, commission-based income that maybe doesn't show a whole lot on paper. Those doors that would kind of
the income may not be there, or the income may be there. It just doesn't show on paper on the tax returns. And you need tax return for conventional and the traditional government loans. You do need to qualify. You're going to look at your W-2s, look at your tax returns. That's what they're going to base it on.
Now, you mentioned credit score being one of the qualifications. What are the other qualifications somebody might want to pay attention to, or when they're going for their pre-approval?
Well, there's typically 3 keys. It's not that complicated. There's really 3 keys in qualifying for a mortgage. First is we talked about the credit. You have to have a certain credit score. The bank is going to want to see you have the ability to pay your bills, pay your liabilities on a monthly basis. So credit is going to be a key. Assets, which is the down payment or funds that you have for closing, be it 3%, 5%, 10%, 20%. They're going to need to confirm and verify that those assets are there. And then the last key is simply the income that you make versus your liabilities. How much income you have versus the liabilities that go out every month. You may have someone that is a high earner, but they're also a high spender. They may have multiple car loans, boat loans, jet ski loans, other investment property loans. It all comes into debt ratio. How much income you earn or you have on paper versus your monthly liabilities. Those are really the 3 keys. You've got your assets, your credit, and your income versus your liabilities. And the liabilities do include the new housing expense, the house that you're looking to purchase.
I think a lot of buyers get stuck up on the credit thing, right? It's usually the number one topic that they bring up when they're in the process of getting ready to purchase a home. Like, our credit isn't really that great. So, like, coming from somebody who's in the industry and someone who does a lot of mortgages, what would you recommend to them to maybe get ahead of the game before they purchase, to get that credit kind of up or resolved? Is there any tricks?
Yeah, I'll tell everyone there's always a path. I mean, it doesn't matter how filed up, whatever happened in the past. You may have had credit issues 2, 3, 4, 5 years ago, and you may not qualify right here and now. But I've had so many people come to me saying, look, I want to buy a house. I don't know what to do. I look at their situation. You can take a look at each individual situation, and they may have in their head what they think they need to do to fix it. But the reality is that this is what I do every day. It's how I make my living. I get people on that path so that they're in position to buy a loan. They'll come to me and I'll tell them, I'll look at each individual situation. Okay, you need to do this, 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 and this. If you do that, there's a real good chance you'll be in position to purchase that home. And it may not be now. It may be now, maybe 3 months, 6 months. It may be a year from now. I've had clients that I've worked on for over a year. They listen, they do what needs to be done, they pay off whatever debts, and it's not always about paying off debts. Sometimes it's showing more income. If you're self-employed, showing, okay, you cannot write off as much income as you have been. You have to show it on paper. It is an advantage being self-employed that you do get to hide or shelter some of your income, but it's going to hurt you when it comes time for a mortgage. Now, there's always going to be a path, and each path is going to be separate. It's going to be individualized. So I need to set them down that path so that they're in position to get in position to buy that house.
That's a good point, actually. A lot of people get discouraged if right then and there they can't qualify for what they want to purchase. And they kind of think like, oh, it's over for us. But somebody like yourself, and you just mentioned it, you set them up on, some guidance and maybe like a list of what they need to do. So maybe in 6 months or a year, they can buy something. I think we've done that a few times.
Yeah, we've had numerous people where they've got to pay off. There has to be, I'm working with a client right now where he tried qualifying sometime early summer, and it simply wasn't right. The time wasn't right. He needed for X number of months to pass before there were any late payments. There was a history and there was a reason for it, but we had to wait for the certain time to lapse. As long as everything was made, payments were made on time, there were no late payments, he'd be in position to purchase a home, and that's what he's doing. I mean, we're like another step away. We've got another month or two, and he'll be ready to go out there shopping, buy a home. So I feel good about that. He was a veteran and went through some things years ago, and he was really excited about buying a home. And when I told him that he didn't qualify, I said, look, don't beat yourself up. What happened has happened. This is where we are. Let's get you on that path to fix it. And we stayed in touch. Every once a month we would connect and just make sure that he's doing what needs to be done. And here we are, 6-8 months later, and he's ready to buy a house. So I
think that separates like the seasoned lenders, think of realtors, seasoned lenders, and maybe, non so seasoned lenders where some of them might just be like, hey, you can't qualify right now.
That's it.
Take a hike, and they don't set them up to maybe do something where they can qualify in the future. And then they feel discouraged, those buyers, so they can't buy anything.
Another example is self-employed. Maybe someone was a W-2 employee for a certain amount of time. They went out on their own, got ambitious, decided to start their own business. As a self-employed borrower, you need to have 2 years of employment history to qualify. So they may get frustrated. Geez, I've been doing this for a year. I want to buy a house now, making good income. We need that 2-year income or 2 year on that to confirm self-employed so that you can qualify for that mortgage. So I'll stay in touch, and we wait. We're already flipping the calendar to February next week. So time ticks. Yeah.
And some are easier than others, right? I know we've had some more complex situations where they had businesses out of state. We get that a lot actually recently. Business out of state, they're looking to buy a home down here. But I think there's, you mentioned it before, you can't transfer. The business has to be here in order to get that loan to purchase down here. Or to show that the business income is there.
Yeah. Well, that was for, and we'll touch on that in a little bit, down payment assistance. We were working with a potential client that wanted to take advantage of a down payment assistance program. They were qualified, and they were out of state. They were an out-of-state buyer bringing their business here, but because it's not here, not established at this time, we couldn't use the down payment assistance. But we can use that income because they're still generating that income out of state.
Nathan, can you talk about the first-time homebuyer assistance or any programs like that? Because I get that question a lot, and I'm never really certain how to answer.
The down payment assistance, they're constantly changing. Their programs that come out have an allotted amount of funds available for these down payment assistance programs. And when the funds are gone, they're gone, and that program will disappear. And then maybe they'll come back 3 months, 6 months, a year down the road. But there are state down payment assistance programs. It goes all the way from the state, county, city, even community. Certain zip codes will have down payment assistance programs. So, and they're not always there. It's not like if it's a program is here now, it's going to be there in the fall. They may run out of funds. It may be a 6-month program, a 3-month program. But
would
if
somebody
you do
need
your
to talk to would somebody want to talk to a lender to find out about all the different
Yeah, because
programs
that's
and
my
what,
job to find out. And no one can know every program that's out there, but I know how to find out where they live, where they're located, where they're looking to purchase. I can find out what programs are available in that community at that given time.
Yeah, there's a bunch of like other programs, at least that I've heard of, outside of just down payment assistance, like for law enforcement, government, maybe
Yep.
assistance.
No, there are. There's the big one in Florida comes up every summer. It's a very good program, the
Some heroes.
Hometown Heroes. But again, that goes quick. It usually, in a lot of the down payment, and not to get off track, but a lot of the down payment assistance, it's tough to fit into that box because there are income limits. If you earn X, there's a certain amount of dollars that you can earn. If you earn over that, you don't qualify. You have to, it's a tough little box to fit into, but for those that fit into it, it's a great opportunity.
Yeah. Now, probably biggest thing when it comes to loans, people decide to want to purchase their first home or secondary home or whatever loan they're getting it for, is interest rates. That seems to be a very hot public topic. Most things people get hung up on when they're getting a loan. So what can you tell us about interest rates and how much they really affect your loan and what you see in the market? I mean, and what is maybe your predicament of where it's going to go in the future, these upcoming months?
Well, to address that one, I've given up on predicting what's going to happen with interest rates. We've heard for 2-3 years now, at least, that rates are going to drop, rates are going to drop, rates are going to drop, and they simply haven't. They move on a daily basis, but they'll fluctuate. They'll go up and down a little bit each day. But in general, we got spoiled with COVID in the 2s, 3s, and 4s, and we're just not there now. We're in the 6s and 7s. Who knows what's going to happen? Like I said, for 2 years, I've been telling people that, and hearing from the so-called expert that, the rates are going to come down. Rates are going to come. The election's coming, rates are going to come down. And it hasn't happened. So who really knows what's going to happen? Can't control that. I mean, the rates are where they are. But what you can do is take advantage of the current market with taking care of your own house. Keep your house in order. And when I say your house, I mean your personal financial situation, because credit score plays a big factor in what you're going to get for a current, for the interest rate of today. If you're in the low 600s, you're going to get a substantially different interest rate than someone in the high 7s. So, and that's all something you can control, you as a buyer. So if you can keep that score up, you're going to get the best possible rate at that given,
Yeah, for buyers too. I mean, take advantage of the incentives that are out there. I mean, in my opinion, it is still a buyer's market. I mean, so you might get a higher interest rate, but understand what that allows you to do. It reduces the competition out there currently because people are afraid to buy at that higher rate, and take advantage of some of those, incentives that you can probably get. Get the lower purchase price in the house, negotiate it down. I tell people all the time, do the 2-form buy down. Try that as well. Ask for closing costs back. That might make up for that higher interest rate.
It is. I think it's a great time to buy. I mean, the three of us have had this discussion. I mean, the buyers have the leverage right now. You guys have listings. It's not easy to sell a house right now. And when you do get those offers, they're coming in low. Like I said, as a buyer, you've got some leverage because people want to sell their homes. And when rates, if rates drop, there's an influx of buyers that are going to jump into the market. And when that happens, now you're going to put the leverage back into the seller's hands. And it's in all likelihood, kind of Econ 101, the more buyers that enter the market, it's going to fluctuate, or it's going to increase the purchase price. So if you get in today, if you've got, as a buyer, you have leverage today, get in, purchase the home today, get the reduced purchase price, get the seller to pay some of your costs. And then if and when rates drop, capitalize on the lower interest rate. You've got the opportunity to refinance your mortgage, save a point or two on the rate. You're getting the home at today's pricing with tomorrow's interest rates. So it does make sense to buy in today's market.
The other question I get a lot, what are the costs associated with getting a mortgage, getting a loan?
You're going to have anytime you buy a home, when it comes to a mortgage, you're going to have your loan costs themselves, and that's going to be your underwriting costs, You're going to have an appraisal, a credit report. You're going to have title fees, title insurance to ensure that no one else can claim ownership to your home. And that's, again, a different department. Each title, each county, they've got their own fees set up. Like I said, you've spoken with your title company, so you've probably had that conversation. But going back to, you've got your loan cost, which is going to be your underwriting. You've got an appraisal. You're going to have a survey. You're going to have a credit report. In addition to the loan fees, you're going to have your title fees. And then in addition to that, you're going to have your government recording fees, taxes, just like when you're buying a five. And it's going to fluctuate. It's going to vary with the loan amount size or the purchase price.
Is there like a rule of thumb? So say like 2% of the purchase price is what you would use to estimate your closing costs?
It's a safe estimate.
Okay.
But it will fluctuate. The actual dollar amount's going to fluctuate with the purchase price of the loan amount size. Just like if you go out and buy a $500 TV, you're going to pay a couple of bucks in taxes. You buy $10,000 worth of furniture, now you're paying hundreds of dollars in taxes. So
makes sense.
It will vary as far as that's concerned.
I guess it depends what's negotiated between the seller and the buyer on, closing cost assistance or giving back at the end will also reduce that for the buyer side.
Yeah, we see that a lot today where the seller is anxious to sell that home and they're helping out the buyer. They want to put the deal together, so they're able to take that cost on to make the deal happen. And it's great for our buyers.
Yeah, buyers always ask for recommendations when they're making an offer. When they come to us, they finally found that house and they're like, hey, we want to put together an offer. Let's offer 20, 30 grand less. I said, or probably the better route that might better suit you and help you in the long run is, why don't you keep that money in pocket and ask them to cover your closing costs? That's, to me, personally, it's something that I'd probably take advantage of. And I recommend to some of the first-time home buyers that don't want to empty their entire savings account into the house and maybe put away some rainy day funds, and do it that way.
Hold on to that cash. Keep the cash in hand.
Well, you kind of mentioned that
as opposed to $10,000 or $15,000 off the purchase price, which isn't going to do a whole lot to their payment. But if they're going to cover that in cash, closing costs, it's going to look a lot better in their bank account.
Well, and what we've done before too, instead of asking for the money off the purchase price, instead doing a credit for that 2-1 buy down that Dante mentioned earlier. Could you explain how that works, Nathan?
With the 2-1 buy, yeah, that's it's a cost to the seller, and what it does is, we'll just take a general rate. Let's say rates are at 7%. On a 2-1 buy down for the first year, the interest rate would be 2 full points off from the locked interest rate. So if they lock in at 7%, their first year will be based on a payment will be based on 5% interest rate. Year 2, it'll go to 6%. And then in year 3, it goes back to the full 7% locked interest rate, or whatever the rate is when we decide to lock in. But that's because that could be hundreds of dollars in savings.
Right. Instead of asking for $10,000 off the price where it wouldn't save you much, that buy down will save their monthly budget.
With the idea that, going back to what we talked about a little while ago, with lower interest rates in the future, if year 1 they're at 5%, year 2 they're at 6%, maybe sometime in that time frame, year 3, rates do drop, they can refi into that lower interest rate and never pay the fully indexed rate.
That kind of gives you the advantage of being able to buy at a lower rate, seeing what happens in the next year or two to see if you can, refinance and get that lower rate that you wanted initially. And so to actually reach that 7% at the final third year.
It would have to be clear, let them know that, okay, this is what your rate is going to be. It's going to be X rate. And let them know that in the future, it's going to be at this rate. Year 1, it's going to be this. Year 2, it's going to be this. But year 3, if you stay in this loan, it will be at this rate. And it'll be at that rate from there on out.
Now, a question I've never asked before, and actually it just came to mind, is if you do that 2-for-1 buy down and you do the first 2 years where it's lower, is there ever a case where if the rates never go down, but they actually exceed that final rate, does that affect their rate that's locked in?
No, it's a 30-year. They lock in the rate just as if they were doing a traditional 30-year fixed rate. You pick that rate, you're locked in. That's what it is for 30 years. So do you mean like if within that 2-year period, it shot up?
Let's say they go from 7 to 8 or 7 to 7.5, and you're like, dang,
nope, it's locked in.
So that's another benefit to the buyer side is I know people, again, a lot of them are hung up on the interest rates, but who knows? I mean, something could happen to where the rates, not that I'm saying it will, or we can guess, but if they do go,
Well, no one knows.
You just save yourself from getting even a higher rate,
Mm-hmm.
in essence. So, just things to think about, as buyers.
No,
One thing
it's a great tool. And like I said,
I wanted to ask, just because I know when we put this up. So we say, it's a great time to buy because in the future you could refi, but that's not guaranteed, to be clear, right? I think it's like what you said, keeping your house in order. So, there's a certain amount you'd have to have paid off, or, you'd have to qualify for that refi. Would that be
correct.
right?
Yeah. No, you always want to, it always, there's no guarantee, because if you have a job change or credit issues, just because you qualified here in 2025 to buy the house does not mean you're going to qualify for a refi in 2027.
And,
I mean,
and I just want to point that out to be, not.
Yep, you have to go through the process all over again.
Got it.
So as we discussed kind of like different types of loans and what you could do ahead of time to set yourself up to qualify for a loan, what are a lot of mistakes that buyers make during the mortgage process? What are some things that you've seen that buyers have done that maybe hurt them for purchasing?
Through the through when they come to me to get pre-approved till closing, if they're good to go right now, I would advise pretty much stay put. Don't take on new debt. This is a big step in your life. You're trying to buy a house. You want to secure this. If you're in position now to buy a house, you don't want to blow that opportunity. You don't want to take on new debt, especially if it's unnecessary. But I've had people do that. They'll go out, get a car payment, take on it, they're approved, ready to go. They're out shopping. And then we get a notification because we monitor the credit. We have to. And we see a new account has been opened up. If they're right on that line of that debt ratio where they can't afford any more debt and they've got a new $400 or $500 car payment, it could put them over the edge. So that's a big mistake. Don't take on new debt. And I'm always quite clear to people, look, you're good here. Please don't open any new accounts. If you need to, just run it by me and I can run the numbers. And if you're in jeopardy, if it's going to put you out of qualifying, don't do it.
And I think maybe that happens because now that I'm thinking about it, buyers think, we're pre-approved on the contract. Or now.
They think it's over.
Right.
It's not.
They think, we can go buy, that Corvette or Mustang and be totally fine.
Close. Not until you close. And we've had that. It didn't affect anything. And this goes back, 3 or 4 years. I had a guy he was buying a house, and I think actually I take it back. It was a refi. It was back during the COVID era. Rates were 2, 3, 4%. In the process of refining, just prior to closing, we got notice of an inquiry. BMW, showed up on the credit report. I called him up, sir, what's going on here? I was pretty good with him. He and I were pretty tight, and we were kind of chummy. And I asked him, I see BMW ran your credit. Did you go out get a new car? He's like, well, yeah, my daughter's going off to college, so she needed something to get to and from. It didn't affect his ratio, but yeah, $600 BMW payment on the credit report. But I thought I got a chuckle out of that. It didn't affect him, but for someone that was real close on debt ratio, it could have been an issue.
Yeah.
Another mistake that I've had is don't change your job. If I've had many people think that, okay, I can't wait. As soon as I close, I need to get a new job. I had a nurse that was dying to move hospital. She had an opportunity, but there was an overtime situation that we needed. We needed her to stay put, stay where she was at. And she did. She ended up staying at her job. We closed on the house. And then shortly thereafter, she went and left her job, found a new employer. But that worked out fine. It was another transaction where we got our clear to close. We were done, ready to close. And this was also on a refinance transaction. The woman was so anxious to leave her job, she quit her job. She already had another job lined up, quit her job, and we do a final verification of employment just prior to closing. They have to, within a certain number of days prior to closing, do a verification. The day before closing, we found out she did not or she was no longer employed.
Oh, did she lose the whole thing?
No, it did. It delayed it because we needed to, okay, let's start over. Now we need to get 30 days worth of pay stubs at a new employer. So basically it delayed everything for about 30 days. But
Is there any type of hindrance or penalty in that situation if they're leaving a job but staying in the same industry and going to another job in the industry? I can see why it differs if you're going to
if it's just, you can do it. If it's a similar, if you're a straight W-2 employee salaried, you can do it. It's a little bit more paperwork, a little bit more of a headache, but it can be done. The issue I had with the nursing, I don't want to get too complex, too deep into what it takes to get, for qualifying for certain positions and so forth. But when you use overtime, you have to track a 2-year history of it. And she was getting overtime at her current job, but she was not going to get overtime at her new job. And we needed that overtime income for her to qualify.
played a big role in the income.
Right. She would not have, she was going to take a pay cut where she was going, working a lot less hours. She needed to for family purposes, but because there was going to be a decline in income, it would have kicked her out of her loan approval. But that's the big thing. Taking on new debt, changing employers. If you're in position, you're approved, just stay put, stay down, get to the closing table, and then do what you need to do to make the adjustment.
How much would you say a person, say they're doing an FHA loan or a VA loan, one of the government-backed loans, because with conventional, you can do, you mentioned all the way up to 20%. But what would you say is the minimum amount money a person should have put away or maybe be ready to receive as a gift if they're looking to buy a home?
With FHA, you can go conventional 3% if you're a first-time home buyer, 5% if you're not with, if you currently, or if you're no longer a first-time home buyer, if you don't qualify, if you've owned a home within the last 3 years, you need to put 5% down. For FHA, it's 3.5% down. So you need to have 3.5% down for a down payment, plus any closing costs. In today's market, but not all markets are like today. Today's market, you can often get the seller to cover those closing costs.
And that's why it's a good time to buy right now.
Right. So you now need your 3.5% plus closing costs, which can be $10,000, $15,000 in some cases. And if you can get the seller to pay for that, that's great. That's today's market. It's, as we know, it wasn't like that years ago. It may
And
not be
borrowers
like
can
that.
also, can they have a gift from family, maybe a parent that wants to help out, or?
Yep. Immediate family member that you can get a gift.
Now, speaking on those loans, like conventional FHA, there's an acronym that gets asked about a lot, right? Concerning some buyers. It's PMI. So first, tell us what PMI is.
With PMI, that's private mortgage insurance. And that's insurance that you're paying the bank, the investor, so that if you default on their loan, they're essentially protected. It's an additional fee that you're going to pay to them. With a conventional loan, the number is 20%. If you're putting 20% down, you don't have to pay that extra fee. That monthly insurance, private mortgage insurance, you pay that monthly. And that is credit score based. It's also based on how much you put down. If you're putting 3% or 5%, say 15%, you're going to have much more expensive private mortgage insurance. Now, with a conventional loan, that will drop off when you hit 78% of the initial purchase price. When your loan is paid down 78%. People don't usually wait that long because home values increase. If they think that they're going to be at that 20% or more in equity, they can go out and get their own appraisal. And that's usually what happens. It's on all FHA loans. And it will, if you put 10% down on an FHA loan, after 11 years, it will drop off.
Okay.
But if you don't put 10% down, it's always going to be there.
And it's not on a VA loan?
On a VA loan, no. They have an upfront mortgage insurance premium. And it's a percentage of the loan. One-time fee that gets financed into it. So it's not out of pocket, and they don't have monthly payments on that.
Now, I've heard, different agents and some people go back and forth on how strong a VA offer can be. And me being a veteran, I used it to purchase my home. Can you speak on that? Is a VA loan I don't know how to say it, weaker than, say, an FHA or a conventional loan?
No, a VA is a great loan. There's a stigma out there. And again, years ago, they used to have tighter appraisal, some other restrictions. But for the most part, if they're not willing to accept a VA offer, there's probably going to be a reason. There's something wrong with the house where it may not pass a VA inspection. And if that's the case, then you might be leery of that. For a veteran, no money out of pocket, it's a great opportunity. It's a great loan. Like I said, the pricing, the interest rates are usually a little bit better. It is a little more of an expensive loan because you do have that upfront mortgage insurance premium. But again, it's financed into the loan. It's tacked on to the base loan amount. So you're actually borrowing more than the purchase price.
Gotcha. Okay.
But no, to answer your question, no, there's no problem whatsoever with VA. And like I said, you can get away with a substantially lower credit score than you would with conventional. It's a great loan. It's a great opportunity.
I do see sometimes, and this could be just a personal experience, but the requirements on the condition of the home are a little bit strict.
It can be a little bit, but again, if someone doesn't want to accept that VA offer, there's a reason, and you'd want to do a little bit of digging, find out what's wrong. What are you? I don't want to say what are you hiding, but what are you concerned about that the VA is going to find? The VA, they're out there. They're protecting their vets. They don't want the vet to get into a bad house.
That's true.
It's the reason. Why don't you want to accept this VA offer? Why aren't you looking at it?
I mean, regardless of the loan, you should be doing inspections and
Yep.
taking looks at what's going on with the house, make sure the conditions of the car.
Yep. And let me ask you guys regarding inspections. Is there a difference that you would do with a home, or is a home inspection a home inspection? Do you let them know it's a VA?
No, a home inspection's a home inspection. The buyer can choose how in depth they go, but at least from my experience, it's kind of like you said, the home has to be in a good condition for VA or FHA. So if there's any wood rot or anything that's gonna I can't think of them now, but there's a list that I usually bring with me if I know that that's the loan type, and I'll make sure that the property meets those conditions. So it's like you said, they're not going to let you get purchase a home that isn't up to standard.
Correct me if I'm wrong, I've only had one VA loan. It was quite a long time ago. But I believe a WDO, a wood destroying organism inspection, is required.
It is required
on a VA loan. It's not required for anybody else. It's option.
Right. And that could be okay if they're concerned about it, then they should be upfront and say, hey, we've got a termite issue. I mean, you don't want your buyer getting into that home.
I wouldn't always go by this, but as a realtor, when I look at houses for clients online and I see that they're accepting every type of loan possible, it just gives me a little bit of feeling that
it's a clean, there's nothing.
It's in better shape or in better condition. But
I know that if they've put that on there, they're confident in how the home is. Yeah,
but don't get mistaken. Sometimes just sellers don't want to go through the extra process of going through a VA loan or deal with. They just want a simple cash conventional. That's a personal preference of theirs. Which I always ask: is there a reason why you're not accepting this? And they're like, no, we just didn't want to do it. Well, we have a good offer here, so why don't you take a look at this VA offer? And you never know.
And years ago, the appraisals were done differently. And that stigma is still out there. With any of the government, the FHA, VA, that they don't want to go through that process. But it's really, I think that's the big thing is going to be the termite inspection.
I'm honestly surprised in Florida, given, we're a state that has typically more retirees than other states. You don't see more.
But you really don't. And like I said, it's a great program. I mean, I don't want to say it's easier to get through underwriting, but they're going to let some things slide that a conventional underwriter's not going to let slide.
Can you think of any reason of why somebody would, if they had the opportunity to do a VA loan, why they choose a conventional over a VA?
Probably cost, because again, you do have that upfront funding fee with the VA, but a lot of time it's going to be offset because the government loans are priced a little better. You're going to get a lower interest rate.
I was going to say from my own experience, it was, even when I refinanced, it was lower than even the best rates.
Yeah. So it's
a 0% down payment, right?
Yep.
So I think somebody that comes with a lot of cash, that might be the better suit for them.
Yeah, if someone's got that 20% down where they're not going to pay the insurance, sure, go conventional. But if you're going to pay mortgage insurance regardless, I think that the government loans capitalize on that lower interest rate.
A big question, which is usually what the lender is when locking a rate What does that do? And then when's a good time to?
That's always a tricky one. Rates are changing every day, and you really never know which direction it's going to go. I mean, unless you're real savvy and follow the markets really, really close, if you're under contract and you're happy where that rate is, I would lock in at that time. And that's usually where I advise most of the clients. If they want to float it, again, what you have today, you may not have tomorrow. And it's just like, it's very difficult to time. It's like buying a stock, and you never know, you know, what's going to happen the next day, 2 days, 3 days, a week from now. So if you're under contract and you're happy with where the rates are, it's usually best to lock in right then and there.
Yeah, and it honestly, I mean, I know we crunch numbers all the time, but when you find that house that you love and checks all the boxes, you know, and it's different between a rate of like, oh, we're at 7%, but I want to be at 6%. You know, go for the house. At the end of the day, that percentage is not going to, you know, really have that large of an effect where you might not be able to find the house again.
Mm-hmm.
You know,
No,
it might
if
go
you're
to somebody
waiting-
else. So don't
Yeah,
think too
you're-
long about it, you know, because if you go back in history, I mean, rates at one point were what? I remember, you know, 12%.
Yeah, up in the teens. Yeah.
Yeah. So it's kind of crazy thing to me that, you know, people, you know, 6%, 5% is high. I know the cost of homes have went up. I understand that. But it shouldn't be a shock that we've never been to something.
No, and you get spoiled. Everyone,
Yeah. Like that's the right word to
everyone's
use.
neighbors at 3% and their parents at 3.5%. And, you know, they're looking at 6 or 7 and they don't like it. They're like, I'm going to wait. It's like, okay, well, when you do, if and when you do wait, chances are you're going to pay more for the house and you're going to have more competition. And the seller's not going to be willing to give those concessions to you.
Mm-hmm.
So again, it goes back. If you find the right house, buy it, and it's at the right price, pull the trigger, get it. And then if and when rates come down, it's likely that your home value has gone up. You can capitalize on that lower interest rate at the time, right? And then you bought it at today's price and you get in tomorrow's interest rate.
Yeah.
You know, there's a lot of people that are stuck. You know, they're trapped in their home because they're at 3%. They don't want to make that lateral move, even though they'd like to maybe move across town, or maybe the kids are gone. They don't use the pool anymore. Again, they're going to have to keep that payment the same. They're going to have lesser of a house. It just doesn't make sense.
Mm-hmm.
Yeah. Why go from 3% to 7%? And that's what's frustrating about today's market. People are just, they're locked into their, even if they want to move, it doesn't make sense to move, which doesn't help us any.
No, I think it all contributes to kind of the way the market is right now. You know, the rates are, I wouldn't even say the rates are high. I think we're kind of normalizing. And it's like you said, people are kind of just hoping that it drops.
Yeah, I've heard it for years. Like I said earlier, I've heard for 3 years now, rates are going to drop. I'm not convinced anymore that they're going to. I mean, they might, but.
I think the buyers and sellers were so shell-shocked at that COVID little era that we now came back to the market. You know, they're like, it's really a normal market. Being 6 to 7 days in the market. This is what the market was before we hit COVID.
No, it's true. Their brothers, their neighbors, everyone else they know is at 3.5%, 4%. They just don't want to be stuck at, you know, they don't want to say, oh, I'm at 6 or 7%. Well, that's where it is today. That's the reality. Just accept it. And
now, I know you never predicted. It's hard for you to, you know, hard to say and put a pinpoint on it, but do you think it's likely in your experience that we
get down into the 3s? I mean, probably no. I mean, that low, can we see 5s, 4s, 5s in the future? I mean, we had that in the early 2000s. We were down in the 3s and 4s. So it may happen, but there's nothing indicating it's going there right now. It may be another 10 or 20 years before it gets down there, if ever.
Right. But put on record for the viewers that he did not say or estimate, just giving his opinion.
Yeah.
I don't want buyers go crazy and be like, well, he said this. And
yeah. No.
Nathan, do you think there's anything we missed? Anything we left out that a home buyer should know when going through the mortgage process?
No, I would just say any buyers out there that are looking, or maybe not buyers now, but they're thinking about buying sometime this year. I mean, here we are in January. If their goal is to maybe buy a home sometime this year, speak to a mortgage loan officer. Doesn't cost anything. You know, we can do what they call a soft credit pull, where that doesn't affect your credit score. It does not count as an inquiry, doesn't trigger any solicitors to reach out to them. But get pre-approved, see where you're at right now. Take, like I said, get your house, get your financial house in order. If you're good to go now, great, keep doing what you're doing. And when the time is right, you can go shopping, go out, get that house. But if you think you're good, you might not be. I mean, we've had that happen numerous times. Hey, I'm ready to go. I've been saving up. We've been saving up for 3 years now. I'm ready to buy a house. Well, yes, you have the assets, but there's some credit issues we have to deal with, or there's some income issues we have to deal with. Let's, like I said, just get your house in order. It doesn't cost you anything. Doesn't take that much time. Get pre-approved. And then if you're good to go, great. Just sit back until you're ready. But if you're not ready, let's take these steps so that you are ready by the end of the year.
What does it hurt? I mean, I do.
Yeah.
Yeah. I have one last question, and I'll let Nathan answer it here. So I get this asked a lot when we recommend you as a local lender, and some of our clients maybe have done business in the past, or they, they've gone to Bank of America or Rocket Mortgage. What separates you from them? Why would it be beneficial for a borrower to speak with somebody like you who's local in this market?
Well, like I said, I mean, you kind of hit it on the head there. I'm local. I know you. I know the market. I know the towns. I've been doing this long enough. I may even know a lot of the listing agents that are on the other side of the home, other side of the transaction that they're looking to buy. I always, well, not always, but for the most part, I'll make every effort to reach out. If you're ready to make an offer, I'm going to take that extra step. And if someone really is putting an offer in, and they've got their eye on a certain home, I'll take that step, reach out to the listing agent, let them know. I won't go into specifics, but I'll let them know, look, hey, I'm here, I'm local, I'm available, 7 days a week. You can get in touch with me. This borrower is a clean borrower. There's no reason not to accept this offer. You and I work together as a team to get this buyer into the home. We've got a relationship. We've worked on numerous deals together. They're out of state mortgage company, or their Bank of America, or their Rocket Mortgage rep. They're not local. They may be based out of state. They don't have the relationship that we have. They may not be available on the weekends, evenings. I'm going to be there working hand in hand with you guys to get that deal. They want that house. I want to put that deal together. We're going to do what we can, and I want to work with the listing agent as well. Let's put this deal together. If there's any problems, that's the first step that I do, is I reach out to the listing agent. Hey, I'm Nathan. This is who you're working with. This is how I conduct my business. I want to get this deal done. I want to get this to the finish line. I want to get the buyers into the home. I want to get your sellers out of their home. Let's work together. If there's any problems, I'm going to come to you. We'll work together as a team and get it fixed. No, I do. I love the clients. I want to take care. We get to know our clients. I develop a relationship with them. I want to get them into a home. I work hard to get whatever we can do to get that done. I want to get it done. If there's an issue, I'm not going to, neither of us, shove it under the rug. We're not going to hide it. We're going to address it front and center. Work together as a team. Whoever we need to pull in, be it the title company, be it the listing agent, whoever it is we need to pull in to get it done, we're going to find a way to get it done. That's, and sometimes it's a year, a year longer. We're in touch and we're having conversations, and they're not ready now, but we'll still get in touch, and just, that's what's important, is just staying in touch, being present, making sure that we're able to get their goal to the end, get to the finish line with them, get them into their house.
And from a buyer's perspective, I think our relationship, lender to realtor, is also, when the realtor is close to the lender and they know how each other work. Now it actually is beneficial to them.
Mm-hmm. Yeah.
Yeah.
No,
it's especially
you never
helpful.
know. I mean,
Well, especially if you have multiple offers, it's always great to be able to have that relationship with us, where you can call and speak validity of the buyer, how qualified they are, and maybe win that when otherwise.
Yeah. No, I find that's very helpful. I love reaching out to the listing agent, and I just let them know, hey, I'm here with this buyer. I let them know that I'm, for real. This is what I do for a living. This is how I feed my family. I'm going to make sure that you get your client's house sold. We get our buyer's house into that home. what's it going to take? We're all on the same team here. We all want to get to the finish line, and I just pull everybody in and do what it takes to get the job done.
Yeah.
So
Awesome.
yep.
Well, hey, Nathan, we appreciate you sharing your insight as a mortgage originator and helping some of these buyers understand the loan process and what it entails. And I'm sure we'll do another video at some point. I'm going to maybe some more complex stuff.
No, my pleasure. I love talking with you guys. Love working with you. So no, we'll do it.
So Nathan, thanks for joining us today, taking the time out to give us your insight on perspective from a mortgage originator and the loan process for buyers. And we hope to have you back on sometime, maybe talk about some more complex stuff. And we'll be sure to attach your information at the bottom of the video. And David, anything else you wanted to?
No. Thank you for your time, Nathan.
No, definitely my pleasure, guys. Good talking with you. As always, enjoy working with you, and we'll let's have a nice 2025. Looking forward to it.
Definitely.
Plan.
All right.
Have a good day, guys.
You guys. Yeah.
All right, see you.